Hello and welcome to the College Investor Audio Show. More loans, student loans, we're going to be talking about today. In fact, a new federal study just came out warning us on grad loan access. Before we get to it, though, anytime you hear anything talked about on the podcast for the last, 6 years? It's been a long time, 7 years. You can find every single topic with its own article, all the resources, all the links that you could possibly need to find out more about it at thecollegeinvestor.com. Also, search for us pretty much anywhere on socials is we're there too, wherever you are. Just search for the words The College Investor. You'll find us. We'd love to connect with you. All right, let's get to the topic today. All right, when Congress passed the One Big Beautiful Bill Act, it changed a central feature of how graduate education in the United States is financed. For nearly 20 years, federal policy allowed graduate students to borrow up to the full cost of attendance through the Graduate Plus Loan Program. That option's going to end in June of 2026. Just a few months away, depending on when you're listening to this. But there is a new report out from the Federal Reserve Bank of Philadelphia's Consumer Finance Institute, very official, that offers one of the clearest pictures yet of what that change could mean for students, families, and lenders. So the analysis finds that millions of future grad students may face a new financing gap, and that private lenders might not be really ready or willing to fill it. Here are the changes to federal grad student lending. Under the new law, grad students will be limited to $20,500 per year and $100,000 total in federal loans. Students in professional programs like law school, med school, are going to have higher limits of $50,000 annually and $200,000 in total. But even those caps are well below what many borrowers currently take on. There's also some controversy on what counts as grad school versus professional school. You can find all that inside this article at thecollegeinvestor.com. But using anonymized credit bureau data matched with graduate enrollment records, the researchers examined borrowing patterns among students who entered graduate school between 2015 and 2024. The findings do suggest that the new caps will bind for a substantial share of borrowers if past trends continue. About 28% of all federal graduate borrowers borrowed more than the new annual limits. For professional degree programs, the share was even higher. More than one-third of federal borrowers exceeded what will soon be allowed. Doctoral programs also showed high exposure, with roughly 4 in 10, 40%. Borrowers surpassing the new thresholds. Even master's programs, where borrowing is typically lower because of the shorter programs, nearly 1 in 4, 25%, would have needed additional financing beyond the new caps. This makes saving, grants, scholarships, planning ahead, and all of the other things that go along with it that much more important. You just can't rely on loans, which is probably a good thing. But how big is this funding gap anyway? For students who hit the new limits, the gap is actually not trivial at all. The report estimates that borrowers exceeding the caps would need on average about $21,700 per year in supplemental funding to continue their programs. The figure varies, though, by institution, type, and degree. Master students at public institutions are going to need $15,000 annually, $15,000, while those at private nonprofit schools closer to $23,600. In doctoral and professional programs, average gaps often exceed $25,000 per year, especially at private nonprofit institutions. We know that. The scales of these gaps do matter too, because federal student loans come with fixed interest rates, income-driven repayment options, student loan forgiveness programs, and so forth. This is especially important in fields like education, social work, and health sciences. Replacing federal dollars with private dollars could significantly raise costs and financial risk for students. Private loans are not a simple substitute. One of the report's central questions is whether private lenders can realistically step in. Historically, they have played only just a limited role in financing graduate education while students are still enrolled. Our own conversations with private lenders have highlighted that generally, no, they're not going to be able to fill the full gap. Among the graduate students studied, 43% used federal loans, Only 4% had private loans during enrollment. Even among those who borrowed privately, most did so with a cosigner. More than half of graduate students or graduate borrowers borrowing privately had someone else backing their loan. Credit profiles help explain why 38% of grad students in the sample had no credit score, or a score below 670, a common threshold for qualifying for federal or private student loans without a cosigner. Now, roughly 13% did meet the federal government's adverse credit history standard, which private lenders generally view as a minimum screen rather than a target. These patterns become a little bit more concerning among students who borrowed above the new federal limits. 4 in 10, 40% of those high balance borrowers had weak or missing credit histories, making them unlikely to qualify for private loans on their own. At for-profit institutions, the risk is even more pronounced. Although fewer students at those schools borrowed above the caps, about 60% of those who did had subprime or non-existent credit scores. Here's what this means for future graduate students. For students planning graduate school after 2026, the report's findings point to several immediate realities. First, a lot of students who previously relied entirely on federal loans are going to need to line up additional financing well before enrollment. And that may mean improving credit scores, securing a cosigner, reconsidering programs altogether. And second, private loans for graduate school, if available for your program, are likely to come with higher interest rates and fewer protections than federal loans. Students facing income volatility after graduation might find those terms harder to manage. And third, access concerns may be most acute for students from less advantaged backgrounds, those with limited credit histories, and those whose families cannot provide financial backing. The report cautions that these students could be kind of disproportionately deterred from graduate education if financing options shrink. And that is our show for today. We'll see how this kind of shakes out in the coming months, hoping that, they kind of figure things out a little bit more. We'll keep you updated. You can always follow us on social media. Just search for the words The College Investor. We'd love to help you along in your journey and keep you up to date on all things student loans and really anything else you need in your money journey. It's all there at thecollegeinvestor.com as well, where you can dive into all the resources and tools we have to help you plan a little bit better as you get toward graduation and beyond. Thank you so much for stopping by today, and we'll talk to you again real soon.